Welcome to our deep dive on the marriage tax trap, specifically how getting married can affect Affordable Care Act premium tax credits and your taxes. We will break down why this happens, what actions you need to take, and how to avoid a painful repayment at tax time. Let's begin by framing the issue and outlining what you will learn in this video. Here is today's roadmap. First, we define the marriage tax trap. Next, we explain how the ACA premium tax credit operates and why marriage can change your eligibility. Then, we walk through the steps to take immediately after your wedding, compare filing statuses, highlight critical deadlines, and include a quick quiz. Finally, we wrap up with actionable key takeaways. This content is for educational purposes only and is not tax, legal, or financial advice. Rules and thresholds can change, and your circumstances may differ. Consult a certified tax professional or licensed insurance agent to review your individual situation before making decisions. The marriage tax trap occurs when someone purchases ACA Marketplace coverage while single and later gets married, but does not promptly update their Marketplace account. After marriage, your household size and combined modified adjusted gross income determine eligibility for premium tax credits. If your combined income is higher, you may no longer qualify for the level of advance credits you received. At tax time, you must reconcile the advance premium tax credit on Form 8962 using the Form 1095A you receive. If your advance credits were too generous given your actual combined income, you could owe a substantial repayment. This is why timely updates are crucial. Let's quickly review how the premium tax credit works. You estimate your household size and modified adjusted gross income. The Marketplace uses those estimates to calculate an advance premium tax credit that reduces your monthly premiums. At year-end, you receive a Form 1095A showing your coverage and the advance payments made on your behalf. You then file Form 8962 with your tax return to reconcile what you received with what you were actually eligible for. If the advance credit exceeded your allowed credit, you must repay the difference. If it was lower than your allowed credit, you may receive an additional credit on your tax return. This decision flow shows the sequence. Once you get married, you report the qualifying life event to the Marketplace, update your combined income and household size, and then determine your new PTC eligibility. If you remain eligible, you adjust the advance credit or change plans. If you are not eligible, it is prudent to reduce the advance credit to zero and consider employer coverage or an off-exchange plan. Regardless, you track your 1095A and reconcile everything on Form 8962 when filing taxes. Here are the immediate action steps. First, report your marriage to the Marketplace within the 60-day window. Next, update your household size and combined income estimates to reflect your new reality. Then, run a fresh eligibility check and preview plans using realistic income numbers. If your new estimate shows a smaller or zero credit, consider reducing your advance credit to zero to avoid a large repayment. Compare options like employer-sponsored insurance, Marketplace plans, and off-exchange plans. Meanwhile, think through your tax filing status. And remember that filing jointly is generally required to qualify for the premium tax credit. Finally, set reminders for when your Form 1095A arrives and for filing Form 8962 at tax time. This comparison highlights filing status implications. Married filing jointly is generally required to maintain eligibility for the premium tax credit. If your combined income falls within applicable thresholds, you may still qualify for some credits. And reconciliation on Form 8962 is typically more straightforward. Married filing separately, in contrast, usually disqualifies both spouses from receiving the premium tax credit. There are limited exceptions, but they are rare and specific. Filing separately after receiving advance credits often results in being ineligible and needing to repay those advances. Let's add practical markdown-style planning tips. First, use a simple budgeting worksheet to model several combined income scenarios and the associated plan options. Consider running a scenario with the advance credit set to zero so you can gauge the worst-case premium and decide whether to change plans. Next, create a documentation folder where you store Marketplace update confirmations, plan selection screenshots, and proof of income such as pay stubs. Also keep any employer coverage offer documents. Finally, set calendar reminders for your 60-day qualifying life event window and for when your Form 1095A is expected to arrive so you do not miss critical deadlines. This table is an illustrative overview of how repayment caps generally scale, with household income as a percentage of the federal poverty level. Exact amounts change by tax year and filing status, and those above 400% of the federal poverty level may face no cap, meaning they could owe the full repayment of any excess advance credits. Always verify the current year's exact cap amounts in IRS Publication 974 or the instructions for Form 8962. This mind map organizes your action areas. First, updating the marketplace and adjusting the advance credit. Second, evaluating coverage options, including employer offerings and off-exchange plans. Third, planning your filing status with an understanding that married filing jointly is typically required for the premium tax credit, with rare exceptions. Fourth, managing cash flow by setting funds aside for potential repayment and leveraging an HSA if eligible. Fifth, keeping documentation like screenshots, Forms 1095A, and pay stubs. Finally, obtaining help from a tax professional or licensed insurance agent where needed. Quiz time. The question is, after you get married while on an ACA plan, which action is most critical to avoid the marriage tax trap? The options are: 1. Wait until tax season and let Form 8962 handle it. 2. Report the qualifying life event and update combined income in the marketplace within 60 days. 3. Do nothing because credits automatically adjust. 4. Switch to any random plan without updating income. You may pause the video now to think about the answer. We will discuss the correct answer in the next section of the video. The correct answer is to report the qualifying life event and update your combined income in the marketplace within 60 days. This ensures the advance premium tax credit aligns with your new household reality and reduces the chance of significant repayment when you reconcile on Form 8962. Here is the next question. True or false? Married filing separately generally preserves eligibility for the premium tax credit. You may pause the video now to consider your answer. We will reveal and explain the correct answer in the next section. The correct answer is false. Married filing separately typically disqualifies both spouses from receiving the premium tax credit, except in limited, specific circumstances. Let's cover common mistakes. A frequent error is failing to report the marriage promptly to the marketplace. Another is keeping a high advance credit even after combined income increases. Many people assume that married filing separately will not affect premium tax credit eligibility, which is usually incorrect. Others ignore potentially better employer coverage options. Finally, waiting until tax time to discover a large repayment obligation can create financial stress. Here are the key takeaways. Marriage changes your ACA household and income calculations, so update your marketplace application quickly. Reconciliation on Form 8962 can produce large repayments if your advance credits exceed your actual eligibility. Married filing jointly is generally required to maintain premium tax credit eligibility. If you are likely ineligible, consider reducing the advance credit to zero. Compare employer-sponsored plans with marketplace and off-exchange options. Keep detailed documentation and seek professional guidance when needed. To summarize, report your qualifying life event and update income as soon as possible. Preview plans and consider reducing the advance credit to zero if your combined income likely eliminates eligibility. Plan to file jointly unless you qualify for a narrow exception. Track your Form 1095A and reconcile everything on Form 8962. When in doubt, consult a tax professional for tailored advice. Thanks for watching. If this video helped you, please like it, share it with someone who is getting married, and subscribe for more practical money and insurance guidance. In the comments, let us know your questions or experiences with the marketplace after marriage and what topics you want us to cover next.